If you answered no to any one of those three questions, then working with an advisor may be the best option.
Hi everyone, welcome to my channel. My name is Reni. If you're new here, welcome. And if you're a returning subscriber, welcome back. Today's video is going to be about financial literacy once again, and this is part 2 of a previous video that I did. I will link part 2 up here, part 1 up here, and in part 1 we discussed the process of working with a financial advisor. Today we're going to be answering the questions that you had about working with a financial advisor, so I hope that you enjoy this and you learn a lot. Personally, I've never worked with a financial advisor, but this was good to know the benefits of working with one, and I learned so much. So I hope that this is of value to you. I hope you learned a lot, and let's get started right now. So as you can see, I have a very special guest on my channel, and we have Philippe here. Hi Philippe.
Hi Reni, hi everyone.
Thank you for being on my channel once again. Philippe, if you want to introduce yourself and tell everybody about who you are.
Hi everyone, my name is Philippe Marie-Jean Robert. I am a portfolio manager and the founder and owner of Kwajamii Financial, a firm that provides both financial planning and investment management services to Ontario residents. My area of expertise includes budgeting, debt management, retirement planning, education planning, investment planning, and of course, portfolio management.
And if somebody wanted to reach out to you even before they watch this video, how can where is
you want
the best place for them to reach out to you?
I am on social media, so Philippe Marie-Jean Robert or Kwajamii Financial. You can also go to the website, kwajamii.com, and there you can actually send me a message directly, or you can email me also at p_mjr@kwajamii.com.
The first question that was submitted by my audience was, at what salary bracket should you consider contributing to your RRSP?
Yeah, so this is a very good question, and the short answer, Reni, I don't know if you have guessed. The short answer is it depends.
Yeah.
Indeed, it will actually depend on your personal circumstances. But before I go any further, I would like to take a moment to briefly review the main characteristics of the RRSP, the Registered Retirement Savings Plan. So what do we know? We know that if you own an RRSP, you do get a tax return on the amount that you contributed and on your marginal tax rate. So the tax return will be based on the level of contribution and also based on your marginal tax rate. So the higher the amount contributed, the higher the tax return. The higher your marginal tax rate, the higher the tax return. And so what does that mean? It means that if you expect your salary to significantly increase in the coming years, let's say that you are currently attending school or you are at the beginning of your career and you expect that your salary is going to grow much further, then it may make sense to perhaps postpone making RSP contributions and instead favor your TFSA contributions. Mm-hmm. That way, you will allow your RSP contribution room to grow until you are at a higher tax bracket and in a position to get the most out of your RSP contributions. So that's one aspect. The second aspect is investments can grow tax-free within the RSP account, but any amount that you withdraw from your RSP is taxed as ordinary income at your marginal tax rate. And so you might want to contribute this time to your RSP if you expect your future marginal tax rate, i.e. the tax rate at the time, your marginal tax rate at the time you start withdrawing from your RSP, mm-hmm. and for many people that would be at retirement. So if you expect that future marginal tax rate to be lower than your current marginal tax rate, yes, it would make sense actually to invest today. Mm-hmm. Now, to complicate things even further, an important factor to also take into consideration is what you would do with the tax return if you were to contribute to your RSP. Some people actually might decide to use their tax return to pay down debt, whether it's a mortgage prepayment or pay down the credit card or any loan, for example. Or some of the people actually might decide to take that tax return and invest into their TFSA, for example. Or other people might decide to split this tax return in half, or however they want to split it, and do both, a combination of both, paying down the debt and invest in their TFSA. So all of this to say that there are many, many different strategies that can be used for different purposes. And so what I tend to, and I do encourage actually people to speak with a financial advisor to help you make the right decision for your circumstances, especially if you are not exactly sure how to proceed. But some cases would require you to make that RSP contributions today. Other situations might actually impose you to actually delay a little bit making those RSP contributions. It all depends, as I was saying at the beginning, on your personal circumstances and situation.
Perfect. So what I really gathered from that is it depends, as you said at the beginning, it depends on your personal situation, and a financial advisor can help you see which situation works best for you. And what I really see is as the benefit of working with a financial advisor is being able to plan ahead, and as you said, basically make a roadmap of your finances. We see that, okay, in the next 3 years, you're going to be making significantly more than now. So maybe in the next 3 years, it's better to invest in your RSP versus now when you can load up your TFSA. So yeah, lots of benefits of working with a financial advisor. Another question that I got, and I have the same question as well. What is the difference between working with an independent financial advisor or investment advisor, or one that works at a bank?
In theory, there should be no difference. In practice, however, I'm afraid there may be some differences, although I certainly do not want to point fingers to anyone. But in general terms, I think the biggest difference is perhaps the potential for conflict of interest.
Okay.
Your goals are perhaps more aligned with an independent advisor, but even in that case, there is still no guarantee. And it all has to do with how the advisor gets compensated. I give you a couple of examples. So, for instance, how would you know that the recommended financial product is the most suitable product for you if your advisor and or the firm the advisor works for receives compensation for selling that product? It doesn't mean that the product is not suitable for you. It just raises a little bit of a question there to ensure that it is indeed perfectly suitable. So another example is firms actually provide or give some targets to their advisors
Yes.
for certain products. And again, the advisor may be tempted to push perhaps these products, even if they are not 100% suitable for you. Again, it doesn't mean that the advisor is going to do this. It doesn't mean that it is happening, but certainly that creates a potential situation or perceived conflict of interest. With such compensation models, whether it's a commission or bonus or any models around those lines that put some incentive for the advisor to sell a particular product, then the potential for conflict of interest is in my mind higher. So in the end, you have to be able to trust that your advisor is truly placing your interest first. And it always comes down to the values, the honesty, the integrity of that person.
Mm-hmm.
And so sometimes I say that working with a fiduciary would perhaps be more desirable. And a fiduciary, for those who perhaps don't know, is a professional who is obligated legally and ethically to conduct their business honestly. But in any case, all conflict of interest, whether perceived or real, should be disclosed so that you, the client or prospective client, can make an informed decision whether to pursue with the engagement or not.
This really emphasizes the importance of looking for a good financial advisor and asking the right questions when you are looking for your financial advisor and doing your due diligence. And
Absolutely.
in the last video, you also explained how to do that. So, what questions to ask. So, if anyone wants to watch that, I will link it up here. And yeah, you have to ask the right questions to make sure this person has your best interest at heart, because it is your money at the end of the day, right?
Absolutely. And take the time to have that conversation. If it takes 2 or 3 or 4 meetings, just take your time for sure.
Another question that we had was, does a financial advisor work with other professionals to manage your money holistically?
Absolutely. Absolutely, yes. And in fact, I strongly believe that you should build a whole team of professionals around you, starting with a financial planner, an accountant, an insurance broker, a real estate broker, a mortgage broker, an investment advisor, a trust and estate lawyer. But you see the picture. I think it is important to have or to be surrounded by a whole team of professionals, and so that you can tap into their specific expertise when the situation demands.
Mhm.
Even for a business owner, why not adding a business advisor actually to grow your business? I mean, but you see the importance of having a full dedicated team of professionals so that you can tap into. Your financial planner, it seems to me, is the person that is at the center of all of that relationships. And this person, the financial planner, will be looking at your overall financial health, much like your family physician would look at, if I can use that analogy, would look at your overall health. And much like your family physician, your financial planner will recommend that you see a specialist when necessary.
Mhm.
I happen to wear those two hats. We talked about this in the previous video, where I am a planner and a portfolio manager. And as a financial planner, I can look at your cash flows, net worth, budget, debt management is one aspect, retirement planning. But when it comes to the implementation, especially when it comes to implementing the plan, then you need to see a specialist. Let's say you want to pass on wealth to the next generation, then, well, you will actually talk to a trust and estate lawyer. If the implementation requires you to build an investment portfolio, well, you are kind of lucky in a way, because I also do portfolio management, so I am also that specialist for that specialty. But you see, the idea is to have a full team of professionals actually to help you out in whatever situation that you need
Mhm.
to fulfill your goals.
Perfect. Yes, I totally agree. And I like that they can all work together to fulfill your goals, because we want to have a holistic management of our money, not just one aspect is doing well and then the other aspects are where we're not considering. Another question that we had was, why do I need an advisor? Can't I just invest my money or manage my money myself?
Well, the short answer is yes, absolutely yes. You can invest by yourself. In fact, many investors are self directed investors. But being a self directed investor is maybe not for everyone, I would argue.
Mhm.
There are three questions you need to ask yourself. The first question is, do I have the knowledge and expertise to manage my portfolio on my own? Well, if you have limited or no investment knowledge, then it would make perhaps sense to work with an advisor in this situation. If you have the required investment knowledge, then the next question that you need to ask yourself is, do I have the desire to manage my portfolio on my own? If you do want, if you do not want to manage your portfolio on your own, and it could be a situation where you would rather spend your time doing something else with your friends and family, then you might want to consider also having an advisor take care of the day-to-day management of your portfolio. If, on the other hand, you do have the desire, you really want to manage your portfolio on your own, then there is a third question that you need to ask yourself. And the question is, do I have the time to manage my portfolio? If you do not have time to manage your own portfolio, and frankly, it does take a fair amount of time actually to do this properly, then it might make sense to have an advisor take care of that for you. So, in summary, if you answer yes to all three questions, that means that you have the investment knowledge, you want to manage your portfolio yourself, and you have the time to do so, then being a self directed investor is probably a good option for you. But if you answered no to any one of those three questions, then working with an advisor may be the best option in this case. And at that point, then you might want to start searching for an advisor. And I know we talked about this earlier, but definitely searching and finding that advisor, the trusted advisor, who would be a good fit.
I guess we use that in every single aspect of our life when we make decisions. So same thing applies when finding a financial advisor.
Yeah, no, I agree. Yeah.
And lastly, when we were speaking earlier, you talked about your investment philosophy, and I was hoping that you could go into it when you spoke about smart investing and what smart investing actually is.
Yes, absolutely, Reni. Smart investing is an investment approach that I have developed over the years. This is an approach I strongly believe all investors can benefit from. And it always starts with financial planning. The analogy we talked about piloting people to their destination. When a plane departs from Pearson Airport to go across the Atlantic Ocean, they have a flight plan. They know precisely the route that they will follow. They know the altitude they will fly, the weather along the way, how much fuel they'll have when they arrive at destination, and so on and so forth. So the same thing applies here, actually. I think it is critically important to build a plan that will help you meet your financial goals. So that's number one. Then, once we have the plan, and we mentioned this already, the next phase is to implement that plan. And implementation usually requires you to invest. So now that you are at a point where I need to start investing, you have to determine whether or not you're going to be an active investor or a passive investor. Active investor really means that I'm or working with an advisor who believes in active management. That means that the person is going to pick stocks in the hope that they're going to outperform the overall market. My view is that it's easier said than done. And after many years in the industry, I came to realize that the best approach is really an index approach, meaning that you don't try to pick stocks, you focus on the things that you can control. So I'm going to actually purchase the entire TSX composite index, and I will get the return that the overall market generates. But where I'm going to spend my resources and energy is on the things that I can control. And I can control many things. For instance, I can control the level of risk that I want to have in the portfolio. I can control how frequently I rebalance the portfolio. And rebalancing means shifting the portfolio back to its intended asset class weights. So let's say that we want to maintain 70% in stock and 30% in bonds in the portfolio. If suddenly the portfolio is 80% in stock because the stock market did very well, then you may want actually to dial down the level of risk that is currently embedded in the portfolio and bring your exposure to the stock market back to 70% as it was intended to be. So things like this. So there are a lot of things that you can control, and so my view is an investor is much likely to be better off. In fact, there are many studies that have shown this, to go with a passive investment approach. Another element of smart investing is to adopt a goal-based investment approach. A goal-based investment approach is for each goal that you have, you want to have a dedicated portfolio. So let's say I want to build some savings to buy a house and provide for a down payment in 5 years. And I also want to have a retirement portfolio, but I'm going to retire in 25, 30 years from now. So because of those two distinct time horizons, then I would argue that it's best to have a portfolio for the down payment, and the risk level will be calibrated for that time horizon of 5 years, as opposed to a separate portfolio that would actually be calibrated for retirement in the long run. So adopting that goal-based investment approach is the way to go for me. Maintaining a well-diversified portfolio across industries, across geographies, across different sectors is a given. um, Applying asset location techniques whenever possible. And that speaks to how efficient the portfolio is with regards to taxes. So we have, for example, the RRSP and the TFSA. We know that the TFSA, all the gains are not going to be taxed. So that's a big difference with the RSP. The RSP, we know when we start withdrawing, that's when the tax liability is going to come in. So that means what kind of assets? Do you want to favor stocks in your TFSA or bonds in your TFSA? um, I would argue that you would want to actually favor stocks in your TFSA, even though your overall portfolio might be 70% stocks, but your TFSA may end up being 100% stocks, if you see what I mean. That's as an example. So, using those location techniques to improve the tax efficiency of the portfolio, rebalancing, we talked about this earlier, monitoring the portfolio is absolutely critical. So that means that because we have a plan, we know that by this particular date, by this particular month, we or specific date, we want it to be at this level. The market value of my portfolio was supposed to be at this level. So now that you have a plan, you can compare to where you are at now. So if there is a deficit, then your current market value is lower than what it was supposed to be, then maybe you want to have that conversation and determine whether or not you need to take any action. If on the flip side, you are well ahead compared to what where you were supposed to be, then maybe I can have a different set of discussion. I can actually think or consider reducing the amount of contribution that I was making to start now saving for a different goal that I had put on the back burner, for example. So that's why monitoring is so critical. And I would say also that the sooner you detect a deficit, the easier it is to correct. You don't want to actually 6 months before retirement discover that, oh, I won't probably have enough funds
Yeah.
actually to spend my retirement income. So that's why the daily monitoring is something that I do every single day. I know where all the portfolios are. So another important aspect is the cost. We know that the higher the cost, the higher those investment fees. All things being equal, this will have a significant negative impact on the future value of your portfolio. So I'm not saying that you have to go with the lowest cost. What I'm actually implying here is you need to assess what you are paying in fees against the value that you are getting in return.
Yeah.
It's common that average fees in the mutual fund industry, for example, is about 2% or so in Canada. Well, that's significant. You have to weight the value that you are getting in return for paying that 2% fees. That for me is so important as well. Once you actually use all of those concepts and principles, that's what I call overall smart investing, by paying attention to every single aspect that I described. Yeah.
So when someone would meet with you, they would get to know your philosophy for investing and what you consider smart investing. And I think that that was a great run through. I actually learned a lot from that. And I think that people should definitely ask those questions when they meet with their advisor or potential advisors, because
Absolutely.
you can see what you are going to do when someone gives them your money. You know that every day you're going to be checking their portfolio. You know that you suggest having different portfolios for each different goal that they have, which I agree with. So yeah, you can see if it actually aligns with your philosophy personally as well. Well, I think those are all the questions that were submitted for you. And I am very grateful that you came on my channel and answered all of them. So is there any parting words that you would like to share with the audience before I let you go?
Yes, again, my overarching message is get started. I think one of the key takeaway is time is your best ally.
Mhm.
Build up your financial plan, build up your wealth, and I think if you get to start on this, I think you will be in great shape.
Thank you again for being on my channel. I really appreciate it. And for everyone who is watching, make sure that you watch part 1 if you haven't yet. And I hope to see you in the next video. Let me know what you learned in this video. And remember, contact Philippe if you have further questions. Thank you once again, and have a great day, everyone. Bye.